Hello everybody, I'm CJ Arlotta, Senior Editor at Hotel Business, and we've got your number. Sponsored by Best Western Hotels and Resorts, We've Got Your Number not only provides our industry with quarterly updates on some of the latest stats and figures from research firms, it also captures input from our industry's most well-respected analysts. Now, onto the numbers. According to a mid-year hospitality outlook report by Marcus Millichap, a specialist in commercial real estate investment sales, financing, research, and advisory services, in Q2 2018, a growing economy underpinned a strong hotel property outlook. With regard to U.S. construction, supply increased year over year by 2%. As of June 2018, nearly 180,000 rooms are underway, the report revealed. RevPAR year-over-year increased by 2.6% in Q2 2018, and annual occupancy is expected to climb 60 basis points from 2017 to a forecast 66.6% at year-end, according to the firm's report. ADR is expected to increase by 3.6% during the year. For additional analysis, I'm joined today by Peter Nichols, VP and National Director of the National Hospitality Group at Marcus Millichap. Thanks for speaking with us today, Peter.
Thanks for having me, CJ. I appreciate it.
Now let's take a deeper look at some of the key points from your firm's report. Tax reform brought about significant changes for real estate investment in Q2. How so?
Well, I think tax reform retained many of the most important provisions used by real estate investors, such as 1031 exchange, and mortgage interest deductions. The new law added several features that will benefit hospitality investors. There's new depreciation rules that allow for immediate expensing of personal property associated with real estate, and that could significantly improve cash flow. Even the furnishings in a hotel can now be expensed, though there's $1 million limit on that particular provision. In addition, active investors using pass-through entities like LLCs can benefit from the new 20% pass-through deduction to boost after-tax yields. This new deduction has a variety of restrictions based on income and asset base, but offers substantive upside for those who qualify.
Now, rising room demand has boosted hotel construction. Over the last 2 years, developers have increased supply, and there are more rooms on the way in 2018. What does this mean for the national hotel inventory by year-end?
Well, although the wave of construction has increased caution among investors, in general, the sector is not overbuilding. Strong job creation, together with elevated consumer and business confidence levels, continues to support both business and leisure travel. So even though the supply is increasing on a national level by 2%, demand is more than keeping pace at the macro level. And on a more granular basis, construction has been largely focused in 10 markets, and it's weighted towards the upscale and upper mid-scale segments. Competition in those metros and those asset classes could be heightened as the new rooms come online, but outside those niches, the impact on the new development will be limited.
Peter, according to your report, smaller markets commanded buyer attention in Q2. Where specifically and why? The capital flow into all types of commercial real estate has increased over the last several years, placing a lot of pressure on yields, especially in the primary markets. Many investors have recently focused their attention on secondary and tertiary markets, where there's less competition for assets and where there's less risk of elevated development. This includes most small to mid-sized cities and even outlying suburbs of major metros. Sort of the wave of interest in experiential travel, particularly by millennials, has also boosted interest in smaller independent hotels that capitalize on unique local tourist destinations. The growth in popularity of smaller cities is evidenced by the 90 basis point jump in occupancies in these areas over the last year, together with about a 3.7% increase in RevPAR. Sophisticated private capital in particular is driving results in these smaller towns and cities, capturing particularly strong yields as a result. Peter, thanks for joining us today.
Sure thing, CJ. I appreciate you having me.
This wraps up this quarter's We've Got Your Number. See you next quarter with an update on the latest industry stats.